Assalamualaikum. Today, our group want to present about financial statement analysis for ACC466, Financial and Management Accounting.
Okay, for the introduction of the company that we have choose is Darby Plantation Sendirian Berhad, and the history of the Darby is Darby & Co. Limited was established in 1910 by British businessmen, which is William Sime and Harry Darby, initially focusing on the lucrative rubber industry before diversifying into palm oil and cocoa cultivation. In 1977, Darby Holding was acquired by Malaysian investor, and in 1979, the company was restructured and relocated at Kuala Lumpur. In 2007, Darby merged with two other major Malaysian companies, which is Qatari and Golden Hopes, to form the current Darby Berhad. The merged entity had a massive land bank of 815,000 hectares as of 2011, making it one of the world's largest plantation companies. Darby has made significant investments, research and development to improve yield, oil extraction rates, and sustainability practices. And this is the picture of the CEO of Darby Plantation Berhad, which is Dato' Sir Jeffrey Salim Davidson. Okay, now we move to the next company, which is IOI Group. IOI Group began in the early 1980s, starting as a plantation company and has grown to become one of the largest producers of oil palm. IOI Plantation Sendirian Berhad is based in Malaysia with the head of office in Putrajaya. IOI Plantation was incorporated on September 25, 2013. The company's latest financial report indicated as the next day revenue drop of 40.47% in 2023. Its total asset recorded a growth of 1.32%. The company has a total planted area of 176,925 hectares as of 2023, which is 84% is classified as a mature. IOI is diversifying into cash crop like bananas, pineapple, and durians to optimize revenue during replanting programs. The company's device business portfolio, which is including industrial, motors, logical, healthcare, insurance sector, has defined its financial performance. So this is the picture of CEO of IOI Groups, which is Mr. Tan Kuen Hua.
Liquidity shows a firm ability to meet its short-term financial obligation, whether the company has resources to pay its creditor when payments are due. The comparison of current ratio is, for the current ratio, Darby Plantation has 1.48 times and 2.94 times for the company IOI Corporation Berhad. Both companies have ratio above 1, that means both companies has more asset than current liability. Comparison of quick ratio is, for the quick ratio, Darby Plantation has 0.63 times, which means Darby Corporation has problem paying current obligation with current asset. The company has 0.63 ringgit liquid asset to pay 1 ringgit short-term liability, while for quick ratio, IOI Corporation Berhad has 2.28 times, which means IOI Corporation is not facing any problem to settle the current obligation with current asset because the company has 2.28 ringgit to liquid asset to pay 1 ringgit short-term liability. The conclusion of liquidity is, Darby Plantation has a problem to settle the current obligation with current asset because they has a lower than 1 ringgit to pay short-term liability, which is 0.63 ringgit liquid, while IOI Corporation is not facing any problem to settle the current obligation with current asset because IOI Corporation has liquid higher than 1 ringgit to pay short-term liabilities. We show a quick ratio of IOI Corporation has 2.28 ringgit liquid. Both companies has more current asset than current liability. Profitability ratio means the ratio that evaluates a business performance during period under review. External users, mainly focused on potential investors, are very concerned with this ratio as they want to measure the return of investment of the business. Higher profitability ratio indicates better performance. Comparison of profitability for net profit margin is Sime Plantation only managed to get 0.03 ringgit out of 1 ringgit sale compared to IOI Corporation that can manage to gain 0.09 ringgit out of 1 ringgit sales. A higher net profit margin indicate more efficient cost management and higher profitability.
Now, let's take a look to a gross profit margin. For gross profit margin, Sime Plantation has a lower gross profit margin with 16.92% compared to IOI Corporation that has 19.53% gross profit margin. At this moment, a higher gross profit means a company more efficient in producing goods or service with higher profit margin. Moving on to the return on asset of Sime Plantation was 4.08% lower than IOI Corporation, which 6.43% of return on asset. The higher return on asset shows that the company has a better performance in generating profit with its asset. For return on capital employed, we can see that IOI Corporation has 11.41% higher than 9.54% that goes to Sime Plantation Company. Calculation proof the IOI Corporation has a better amount on return on capital employed than Sime Plantation Company.
Assalamualaikum, my name is Fikri and I will present about efficiency ratio. This ratio measures the efficiency of a business in managing its capital employed. Based on these ratios, the user of financial statements are able to indicate how fast and efficient the business is in using its asset. For the inventory turnover, Sime inventory turnover ratio is 4.32 times, meaning the company replaced its average inventory 4.32 times within an accounting period. In comparison, IOI's inventory turnover ratio is 11.54 times, indicating the company replaced its average inventory 11.4 times within an accounting period. This suggests that IOI is more efficient at managing its inventory compared to Sime. Average collection period. Sime average collection period is 39.5 days, indicating the company is able to collect its debt within 39.45 days of the accounting period. IOI average collection period is 46.0 days, meaning the company is able to collect its debt within 46 days of the accounting period. This implies that Sime days collection is realizable faster than IOI. Sime total asset turnover ratio is 1.47, meaning for every RM1 of average total asset, the company can generate RM 1.47 in net sales. In contrast, IOI total asset turnover ratio is 0.63, indicating for every RM1 of average total asset, the company can generate RM 0.63 in the net sale. This suggests that Sime is more efficient at generating sales from its assets compared to IOI.
Okay, for leverage ratio, we have three types, which is one is a debt ratio, second is debt to equity ratio, and the third is time interest earned. For leverage ratio function is it can help to measure its ability to meet its long-term debt, and the second is a measure to overall debt load of company and compare it with the asset or equity.
Comparison for debt ratio. Sime have a 53.34% higher than IOI that has 33.62%. Higher debt ratio indicate a higher level of debt relative to asset, which may be considered risky. Comparison debt to equity ratio for Sime is 150.31%, that indicate higher than IOI that only has 50.65%. A higher ratio indicate a higher financial leverage and higher level of debt relative to equity. Comparison IOI is able to meet its interest payment by 12.15 times, while Sandabi only 6.43 times. It shows that IOI is higher than Sandabi. A higher time interest earn ratio indicates a higher capacity to cover interest expense with operating profit that suggests a lower risk of financial distress.
Okay, now we move to the conclusion. The first conclusion we have liquidity ratio. IOI group is sufficiently liquid compared to Standard Plantation. And the second profitability ratio. IOI group has a better amount of higher profitability than Standard Plantation. And the third is efficiency ratio. IOI may have some advantages in terms of inventory management, but Sandabi appear more efficient in terms of asset utilization and receivable collection. And the fourth, leverage ratio. IOI group is less dependent on leverage. The payment ability of this company is higher compared to Sandabi Plantation. In conclusion, IOI is the better than Sandabi Plantation in all aspects.